Outstanding shares refer to the total number of shares of a company's stock that are currently owned by shareholders, including retail investors, institutional investors, and company insiders. These shares represent the total ownership in the company and are a key figure used to calculate important metrics like market capitalization and earnings per share, EPS. Let's break it down. When a company issues shares, it can either keep some as treasury shares or make them available for public or private ownership. The shares that are actually owned by investors, excluding the treasury shares, are called outstanding shares. For example, if a company has issued 1 million shares in total but holds 100,000 as treasury shares, the outstanding shares would be 900,000. Outstanding shares include shares held by various groups: public shareholders, retail and institutional investors who trade shares on the stock market, company insiders, executives, founders, or employees who own shares as part of their compensation or initial stake in the company. Restricted shares, shares that are owned by insiders but may have trading restrictions, like a lockup period after an IPO. The number of outstanding shares can fluctuate over time. For instance, if a company issues more shares in a secondary offering, the number of outstanding shares increases. Conversely, if the company buys back some of its shares in a share buyback program, the number of outstanding shares decreases. Outstanding shares are critical in calculating a company's market capitalization, which is a measure of its size and value. Market cap is calculated by multiplying the number of outstanding shares by the current share price. For example, if a company has 10 million outstanding shares and the stock price is $50, the market cap would be $500 million. Outstanding shares also play a key role in calculating earnings per share, EPS, an important measure of a company's profitability. EPS is calculated by dividing the company's net income by the number of outstanding shares. For example, if a company earns $10 million in net income and has 1 million outstanding shares, its EPS would be $10 per share. Let's look at a practical scenario. Suppose you own 1,000 shares of a company that has 1 million outstanding shares. This means you own 0.1% of the company. If the company decides to issue 1 million more shares, the total outstanding shares become 2 million, and your ownership drops to 0.05%. This is called dilution and can reduce the value of existing shareholders' stakes. Conversely, if the company launches a buyback program and reduces its outstanding shares to 500,000, your 1,000 shares now represent 0.2% of the company, effectively increasing your ownership stake and potentially boosting the stock's value.